One of the most important skills in trading is knowing your daily bias, because if you know whether price is likely to go up or down, trading becomes a lot easier. And the truth is, the candles have been showing us this all along. In this video, I'll show you how I use the previous day's highs and lows to build daily bias, how to tell the difference between continuation and reversal, and how to read price action candle by candle to anticipate the next move. Alright, here's a simple way to think about this. Every single day, price is reacting to two key levels, the previous day high and the previous day low. These levels are important because they're basically where liquidity is sitting. In simple terms, traders have stop losses above the high and stop losses below the low. So naturally, price is often drawn to one of these levels. So in this concept, there's just one important question you have to answer on a daily basis. Is price more likely to take out the previous day high or the previous day low? That's your daily bias. So let's go to our first case. We're looking at daily candles. If price is moving up but the previous day high hasn't been taken out yet, that's a sign of expansion. Price is building momentum and is likely to take out the previous day high. So in this case, we have bullish bias. Same idea for downtrend. If price is moving down and the previous day low hasn't been taken yet, and the next candle turns out to be another bearish candle, that suggests continuation and price is likely to take out the previous day low. So you have a bearish bias over here. But now let's look at the second case. Price reaches one of these levels, let's say the previous day high, and instead of continuing, it spikes above, forms a long wick, and closes back inside. That's what we call liquidity grab. Instead of continuing higher, we'd expect price to reverse towards the opposite direction, and the next day will most likely take out the previous day low. Now what about the bearish scenario? Over here, price comes down, and it looks like it wants to continue lower. But then we encounter a similar situation the opposite way. Price dips below the previous day low, takes liquidity, but it fails to close below. Instead, it leaves a long wick and closes back inside the range. And this is the key idea. If price really wanted to go lower, it would close strongly below, but it didn't. So that tells us that selling pressure isn't strong enough, and once liquidity is taken, price has no reason to keep going down. So it shifts direction, moves higher, and the following day price is likely to take out previous day high. So failure to displace lower means bullish reversal, and failure to displace higher means bearish reversal. So let's take a look at the gold chart and walk through this candle by candle to test our daily bias. We start off with a series of bearish candles, and then we get this bullish candle. From here, I'm watching to see if price can take out this small high and either continue higher or start consolidating. Price pushes up, sweeps the previous day high, but closes back below. That tells me this isn't a strong breakout, so now I'm expecting price to shift lower and look for the previous day low. Price does exactly that. It sweeps the previous day low and closes slightly below. From here, I'm expecting continuation, looking for another move lower. Price continues down, so the idea remains the same. We're still targeting lower liquidity. But now notice this. Price comes down, barely takes the low, and then closes back higher. That's a shift. From here, I'm now looking for price to move in the opposite direction, targeting the previous day high. Price pushes up, takes the high, but again closes back inside the range. So this looks more like liquidity grab than true continuation, and from here, I'm expecting price to rotate back lower. Instead, price holds and starts pushing higher. So now I'm adjusting. This tells me buyers are stepping in. From here, I'm looking for continuation to the upside, targeting the next highs. Price continues higher and we get a strong close above the previous day high. That's more in line with the expansion, so I'm expecting further upside from here. Same idea, price keeps pushing higher, so I'm continuing to look for higher liquidity. But now we see something different. Price sweeps the high and closes back inside the range again. From here, I'm expecting a move lower, looking for the previous day low. Price moves down, takes liquidity, and closes bearish below the range. That confirms the downside for now, so I'm expecting continuation lower. Again, we sweep liquidity and close lower, so the bearish idea is still valid. But then price reverses and closes back inside the range. That's a sign that the move lower might be weakening, so from here I'm looking for a price to shift higher, targeting the previous day high. Now price pushes up and closes higher, but if we look left, we actually tap into fair value gap, which explains this long wick. Price moves slightly lower and we get an indecision candle. Price moves lower again, so there's possibility we come down and take previous day low. But hopefully by now you guys can already see the idea behind this. We're not randomly predicting direction. We're simply watching how price reacts around the previous day's highs and low and using that to build a daily bias. So for the next part, let's use the same exact concept to frame a lower time frame entry. Let's say we have a strong bearish daily close followed by a liquidity sweep and a close back inside the range. So on the following day, our bias will be bullish with the minimum target of the previous day's high, but we could also set targets higher to the next draw on liquidity, such as fair value gaps. Now the important thing to understand here is that the daily bias only gives us directional context. It tells us where price is more likely to move, but it doesn't necessarily give us the exact entry. So what we want to do next is drop down to a lower time frame and look for confirmation. Here we have price action of Zcash, and we're looking at this reversal candle in the middle that started the entire rally. Now this candle fits perfectly with the concept we just discussed. After a bearish move, price swept liquidity to the downside and then closed back slightly higher, suggesting that the following day's bias was likely bullish. Let's say we wanted to trade this setup. What we can do is drop down to the hourly time frame and look for a more precise entry. This candle right here is the last hourly candle before the daily candle closed. So let's analyze what we have on the hourly time frame. First, we already have a change in the state of delivery forming since price is now trading above this level. Second, price is respecting valid order block, which could act as a support for continuation higher. And third, we already know that our daily bias is bullish, so price is more likely to continue moving upward from here. If we were to take this entry with the stop loss placed just below the order block and target the upper wick, it would still result in a solid trade. Now if you go back to the daily charts, we can clearly see a bearish fair value gap sitting above around the $220 area, which can act as our next draw on liquidity. So in this case, we could use the previous day's high as our first targets and the daily fair value gap as our second target. And that's pretty much the core idea behind using this previous day highs and lows to build your daily bias. If you found this video helpful, make sure to leave a like and subscribe if you want to see more trading contents like this. And let me know down in the comments if you want me to make more videos breaking down concepts like liquidity, fair value gaps, market structure, or lower time frame entries. Thanks for watching, and I'll see you guys in the next one.